Okay, good morning, good afternoon, everyone. This is James Bogart. I'm gonna give it a quick minute to let the attendees populate. It looks like it's stabled a little bit. All right, good morning, good afternoon. My name is James Bogart. I'm CEO and president of Bogart Wealth. Real quick, I do have the question and answer box open, also have the chat box open. We are going to be recording this webinar. We'll put it up on the website as soon as it's available for presentation. At the end of the webinar, we do have a brief survey. Would love to get some feedback as well. And then just as a quick introduction, so Bogart Wealth is what's called a registered investment advisory firm. We're fully independent. We're managing about 1.2 billion-ish in client assets. It's approximately 750 households. 90% of those are from ExxonMobil, so a high level of proficiency with the ExxonMobil benefit programs. Bogart Wealth is true fiduciaries for their clients, so we're legally obligated to put your interest above our own. No hidden agendas, no conflicts of interest, and extremely transparent with regards to how we're compensated. There are actually 19 of us now on our wealth management and planning team, as well as 5 on our tax team, so growing a little bit. We've got 3 office locations, one in McLean, Virginia, one in Houston, Texas, and then one in the Woodlands, Texas. And our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. You know, what we've found is your kids and your parents can be some of the largest variables to anyone's financial plan. We've made it part of our firm's culture to give them access to certified financial planners. A lot of what I like to ask is, what would you do differently now that you know what you know, but back in your 20s or 30s? And one of the calls to actions from any of the presentations that we do is to sit down and run your numbers. I think in this environment, it's only prudent. You want to have a baseline, understand where you're at, put yourself in a position to be able to make decisions quickly. We offer this service, absolutely no cost, absolutely no obligation. It's a great way to get to know us a little bit better, but it's also a great way to see where your situation's at. And today's presentation is kind of a drill down into what we've called our retirement readiness series. So we do a whole series of educational content on different things that our clients and prospective clients have asked us to talk about. We do one on the retirement planning timeline, one on retirement income planning, one on Social Security strategies, one on some tax planning as well as tax law changes. I've kind of pushed that one out a little bit to see what the new administration does. We do one on estate planning strategies, one on net unrealized depreciation and post-retirement income strategies, one on long-term care insurance, also one on Roths versus traditional 401ks and IRAs. And then last but certainly not least is one on mega backdoor Roth conversions. So this list came from the audience, and if there's topics that you'd like to see us add to the list, we're delighted to do so. At a bare minimum, we'll add it to an existing presentation, or if it justifies doing a separate segmentation, happy to do so as well. So today we're going to specifically talk about how discount rates affect the ExxonMobil lump sum option. Now, to get there, first thing we talk about real quick is the Pension Protection Act of 2006. Now, the reason we talk about this is because the Pension Protection Act actually changed some of the calculation and the discount rates that are being associated with the pension calculation. But what it was specifically doing was limiting companies that were offering lump sum options to create a defined discount rate calculation. It also created a defined series of actuarial tables. And then it clarified a few other things. So for example, one of the clarifications was that non-spousal beneficiaries can do rollovers. It also clarified that after-tax balances can roll over to a Roth IRA. It also clarified that company matches can be diversified. So anybody who had been doing the extra 1% contribution in the savings plan to get additional 1%, but it had to go all into stock. After 2006, it actually made it so that that could be diversified. Didn't have to only be going into stock. And then lastly, it also defined IRA and 401k contributions and how those are going to be adjusted going forward. So there are 2 groups of households within the ExxonMobil pension program. One is what we call the grandfather category for Pension Protection Act of 2006, and then there's everybody else. Now, in order to be in the grandfather category, this will really apply to anybody who was over 50 at the end of 2007 and had more than 10 years of service, or you were 55 and had 15 years of service by December 31st of 2012, or very simply, you were born before 1958 and hired before 1998. Now, the math for your age group is actually very simple. It's 95% of the 30-year Treasury bond. It gets rounded up to the highest or lowest quarter point. And then the other thing with this age group is they use the ExxonMobil year 2000 mortality table. Now, what we know about the 30-year Treasury rates is for the last 40 years, it's basically been in a downward move. And only recently, if you kind of zoomed into this section, has it started to pop back up a little bit. But what we do is every single week we send out projections of what we're anticipating rates to be for the upcoming quarter to help our clients and prospective clients help make some decisions from a timing perspective. So what we do know is that for the first quarter of 2021, the discount rate was at 1.25% for the grandfather category. For the second quarter, it bumped up to 1.5%. And for the third quarter, based on history so far in the month of January, just as of the month of January, we're trending up to 1.75%. And related to this, as of last Friday, we had 43 more trading days. In order for the discount rate to get up to 2%, we would need the 30-year Treasury rate getting up above 2.0371. Or to stay flat at 1.5, we need the 30-year Treasury rate getting back down below 1.6638. So what it's saying to us is, based on the average right now at 1.73, pretty high probability that we're going to see third quarter go to 1.75% for the discount rate. So this is the grandfather category. Now, everybody else, the math is actually a little bit trickier. This was anybody who was under the age of 50 as of December 31, 2007, or you were born after 1957 and hired after 1997. Now, for this age group, we actually use 3 segmented rates that are all based off of high quality corporate bonds. So corporate bonds are actually always historically higher than Treasury bonds. Higher bond yields is actually worse than the Treasuries. Now, the other thing that happens is that the IRS mortality table gets applied to everybody else. This is being updated every single year. And as of late, people are living longer. So living longer means bigger lump sums. So where we might be using higher discount rates, some of that is offset based on the longer mortality table now. Now, related to these 3 segments, segment 1 will apply to the first 5 years of someone's pension program. Segment 2 will apply to the preceding 15 years after that. And then segment 3 is everything else up to age of mortality. I've got an example to make that a little bit more clear in terms of understanding. But you can see just based on the history for the last 7, 8 years now, actually, what these 3 segments have done. So segment 1 is the green, segment 2 is the blue, and segment 3 is the long-term, the orange. Now, we've noticed segment 3 and segment 2 have moved down parabolically. Segment 1 has gotten back down below any time it's ever been, most likely going to stay at that point for some point in time in the future. What we have noticed is segment 2 in particular has started to notch back up. Segment 3 is also notching back up, while segment 1 is continuing to stay flat. Now, in large part, what's happened here recently is really, we get to thank the Fed for that. The Fed has become a very active buyer of high quality corporate bonds, short term specifically, which is the real big reason why segment 1 has gone down. So segment 1 is designed to replace short term bonds. Segment 2 is designed to replace intermediate term bonds. And segment 3 is designed to replace long term bonds. And I'll explain this in a moment, but we also do a weekly projection off of the all other category. And if you'd like to get on any of our projections or any of our commentary that we send out, please just send us a note and we're happy to add you to it. But what we do know is first quarter was a new historic low. It had never gotten this low. For somebody who was retiring right on their 60th birthday, the blended average for them would be 2.35%. For somebody retiring right at the age of 55, the blended average would be 2.49%. Now, second quarter, ironically, they're staying almost identical. Between first quarter and second quarter, the segment 1 stayed flat. Segment 2 notched up a little bit, and segment 3 came down a little bit. Now, what we're projecting thus far for the third quarter is that we are seeing rates moving up ever so slightly. Now, one critical difference between grandfathered and non-grandfathered. Grandfathered, so anybody who is born 1957 or earlier, we use the entire quarter to calculate the upcoming quarter's discount rate. With non-grandfathered, so anybody born 1958 or later, we actually only use the last 2 months of the preceding quarter. So January has effectively had no direct impact on what the discount rate will be. It only indicates trajectory or trend. And if you think of it in terms of water level, it just kind of rose the water level for where we entered in the month of February. So the non-grandfathered category, your discount rate is only based upon what's going to happen in the last 2 months of each quarter. So February and March will determine the third quarter rate, and we're watching them very closely to help with timing and execution. Now, I wanted to kind of give a quick example to hopefully make the understanding of how these discount rates apply to the pension a little bit clearer. And so this is somebody just using the first quarter of 2021 rates. Segment 1 was at 0.52, segment 2 was at 2.27, and segment 3 was at 3.09. And we just modeled a hypothetical $1 million lump sum number. And what this would be is a $4,579.33 per month annuity, or $54,952. Now, the way the math works, the segment 1 will apply to the first 5 years. So this is just based off of a 60-year-old. So from age 60 to age 64, segment 1 applies. Then segment 2 is going to apply for the next 15 years. So from age 65 out to age 79 is what segment 2 would apply to. And then everything else would apply to segment 3. So for a 60-year-old, it's age 80 through 83, and that's where we have the highest of the 3 segments. For somebody who's retiring younger, at 55, for example, they would have 9 years of exposure to segment 3. And so back to this example where we created the single rate equivalent, what we did was we essentially said this person has 4 years of exposure to segment 3. This person has 9 years of exposure to segment 3. That's why there's a difference between the 2 rates. Okay. Now, in terms of sensitivities, how to understand what discount rates will do to impact your pension, what we typically follow, general rule of thumb, is a 1% movement in discount rates will actually create a 10% change in lump sum. That's, high level general rule of thumb. It's not quite the case. So here's where we actually broke the numbers down. So again, $1 million lump sum. Let's say that rates increased by a whole 1%. Well, your lump sum is going to go down by 9.5%. And you can see the derivations of that respectively. Now, if rates decreased, you'd actually would see the lump sum go up by 11%. Now, truthfully, this is the movement that we saw in 2020 because interest rates have come down. We are believing that rates are kind of in a troughing pattern here, and ultimately we're going to see them gradually rise. Most likely 2021 is not going to be parabolic, but it's going to be more gradual in nature. But I could anticipate as the Fed starts being less active in the corporate bond space, we're probably going to see rates continuing to move up a little bit quicker. And I would also say as the economy gets back to being reopened, we're probably also going to see economic activity that's going to drive rates essentially slowing in a slower pace, but drive them more up. But I think it's a safe assumption with being at historic lows. Odds are going into 2022, we're probably going to see rates higher than where we are right now. All right, another question we get asked a lot is, when should we consider delaying taking the pension? Now, with the ExxonMobil program, if you're retiring under the age of 60, ExxonMobil opposes a 5% per year penalty, early retirement discounts, what they call it, for anyone who's taking the annuity. Now, what I always say is, look, if we don't need the pension or the lump sum money, if there's no economic impact, we should leave it there, assuming you're under the age of 60, or if we're taking the lump sum and we expect rates to continue to fall. But in order to do that, you have to have other money to be able to live off of. It might be leaving the savings plan at Voya and taking advantage of the once a year penalty-free distribution. It might be you've got outside savings or brokerage accounts, but we need to have a cash flow strategy in place in order to be able to consider this. That said, it's an economic discussion. It's all about optimization. And related to that discussion is really understanding the sequencing and timeline of when we need to be making decisions and what the executables will be along that progression. So this is just an illustrative example for somebody who's retiring on March the 1st of 2021, and we're happy to build one out for your sequencing based on when you're looking at. But in terms of the effective dates, the earliest that someone can commence a package, meaning they can request the package from benefits, is 120 days out. So if March 1 is the date that you are planning on targeting from a discount rate perspective, then the earliest you can request it will be November the 1st. Now, typically, I will tell you, it does normally take them anywhere from 3 to 5 weeks to produce these packages. I've seen some instances where they're a little bit quicker recently because of the volume, but I've also seen some instances where they're significantly longer. Typically, we see longer if somebody has separation from service, they're part of a joint venture, or they have a quadro, a divorce decree on theirs. Now, with somebody who's got a March 1 benefit commencement date, just to kind of give you a sequencing of what those timelines look like, your last day on the payroll would be February 27th of 2021. First day of retirement would be February 28th of 2021. And again, a benefits commencement date of March 1, 2021. One thing I hadn't mentioned when I was talking about the non-grandfather category, I wanted to make sure I brought it up. But in order for anybody who's in the all other non-grandfathered category, in order to get that quarter's discount rate, your benefit commencement date has to be within that quarter. And the benefit commencement date is always always the first of the month. So for example, if you want the second quarter discount rates, the last possible discount rate within the second quarter will be June the 1st. Third quarter will ultimately be September the 1st. Fourth quarter will be December the 1st. This is actually different than the grandfather category. The grandfather category has a caveat in there that if you retire right before in sequence, you can actually get the discount rate of either or quarter, whatever the prevailing one is. Now, when that package comes in, I'm a firm believer you want to have your advisor completing it with you. We are making some irreversible life decisions. I want to make sure it's executed correctly. Related to that, we want to look at what the lump sum versus pension election forms are, understand the qualified rollover form, understand the statement of legal address verification form. And then if we're doing the annuity, we need to have a direct deposit form and any appropriate tax withholding. And then if you are fortunate enough to have a supplemental pension plan or an additional payments plan, need to know what the respective forms are for those. So it's the non-qualified pension election form as well as the direct deposit form for those. Now, for a package to be executed on time, it needs to be back 35 days prior to your benefit commencement date. That's not to say it can't be delayed, but for example, in this timeline, we want to have the package back by January the 25th. Now, with anybody who took the early retirement voluntary program, we actually saw a deviation here where they allowed them to go a little bit later and still processed on time. That's not normal. They'll still come back and say they want 35 days prior to benefit commencement date. If you'd like to delay, you haven't made the decision, whatever it is, you've got 31 days after your benefit commencement date to be able to still execute and get that quarter's discount rate. Now, if we have somebody, again, using a March 1 date, your check will get mailed to you. If you're taking the lump sum, it gets mailed to you as a paper check. We'll want to make sure that we get that over into your respective retirement accounts. So that's what satisfies the direct rollover. If you have a supplemental or additional payments plan, we'll have those funds directly deposited into your checking account. Now, after you're in the system as retired is the earliest you're eligible to do a rollover call with Voya. Typically, it takes them 2-3 days to be able to get you coded in the system as retired. So I do know that now anybody who took the February 1 program, they are in the system. They are able to do rollover calls. So you can start doing that if you want to pull the money from Voya. Now, what I will say is there is no obligation to get the money out of Voya. It's important to understand what the tax implications are associated with movements from money with Voya. Specifically, if you're going to look at net unrealized appreciation and have that be a part of your overall plan, we want to make sure that's incorporated. And then what we're going to do with things like after-tax balances. Now, to set expectations for rollover calls, I will tell you another one that I think that you really should have your advisor on the line, somebody who knows how to handle these. I would say from my perspective, 60 to 70% of them have had inconsistencies, inaccuracies, or errors. And it's important to understand what we're looking at. So we want to be a part of that process with our clients. Also reviewing the distribution documents after they've been done. There have been a lot of errors on those as well. I'd actually probably say most of the errors come with the distribution documents, not necessarily the call itself. But again, between the two of them, 60 to 70%. So for anybody we're doing a plan for, we build out one of these roadmaps so we can understand what the critical timeline looks like and what the executables are. But I think it's really important to understand what your sequencing would be dependent upon when you may or may not look at retirement, and understand the nuances associated with it. So in terms of things to look at now, I mean, I go back, we offer to do a complimentary plan. I do think it's important to have at least 2 or 3 advisors you've talked to do a plan for you. Understand what your budget is, understand what your cash flow needs are, understand your risk profile. Along the way with that though, as you're going through and talking about planning, understand some optimization scenarios. For example, right now we love Mega Backdoor Roths. They're a great way of getting money growing tax-free. And that's probably a good segue to present what my next events are going to be. February 10th, next week, I'm going to be doing the webinar again, updated version of the Mega Backdoor Roth conversions. On the 17th, I'm going to be doing the retirement timeline. On the 24th, I'm going to be doing Social Security and some of our Social Security planning strategies. So we'll follow up after the event today. If there's any questions, I didn't have any come in yet today. If there's any questions, feel free to email us. But please take us up on the opportunity to sit down and run your numbers, understand where you're at. Here's our contact information. And if you have a brief moment to do the survey, really would appreciate the feedback. Would love to get better at these. Thank you so much. Stay safe, stay well, stay healthy, and we'll talk more soon. Take care.